Welcome to Delphos Insights. This is episode 42, where Delphos examines how deal structure, not geography, determines whether emerging markets capital raises reach close. Looking at the Delphos research today, there is a pretty wild shift happening. Commercial banks are, well, basically turning off the taps in frontier markets. But the money isn't gone. It is just hiding behind a completely different set of rules.
Right, yeah, exactly. That is the core mission of this deep dive. Delphos observes that as conventional financing channels face, serious regulatory and geopolitical constraints, meticulously aligning your capital structure with institutional mandates is now the decisive filter for achieving market liquidity.
So it is acting as a gatekeeper, essentially.
Exactly. Take Basel IV, for example. Because these strict new global regulations force commercial banks to hold more capital against riskier loans, those banks are aggressively repricing political risk.
Okay, so think of conventional commercial capital as a tightening pressure valve. If that traditional flow is being choked off by regulations, where exactly is the pressure being redirected? Like, how is institutional capital flowing differently to fill that void?
It is building entirely new pipelines. The data reveals the sheer scale of this rerouting. Private mobilization by multilateral development banks and development finance institutions, these massive government-backed lenders, surged from $87.9 billion US dollars in 2023 to $278.5 billion US dollars in 2024.
Wow, that is a massive jump.
Right, and simultaneously, blended finance reached $15 billion US dollars in 2023. So the capital is absolutely there, but it follows deal design, not geography.
Which means if you're putting a deal together, you have to thread your transaction through these highly specific institutional pipelines. You see this perfectly in West Africa with PowerGen's distributed renewables.
Oh, absolutely.
Delphos notes they had to build a blended consortium equity structure, utilizing 5 different institutions just to get that transaction to close.
Yeah, and that was because the sheer scale meant no single conventional creditor could or would underwrite the full capital stack. Standard commercial debt literally was not an option there.
Wow.
They had to deliberately assemble an architecture that catered to the distinct risk appetites and mandates of those 5 separate institutions.
Okay, I have to push back here for a second. That structural necessity makes logical sense for an off-grid solar project in emerging Africa. It hits all the classic low-income development goals. But if you are working in a middle-income market, do you still need this kind of extreme structural engineering?
You actually do. Yeah, sector or income bracket does not exempt you at all.
Right.
Look at MAXXA, the Mongolian Mortgage Corporation.
Okay.
Mongolia actually saw its public debt decline significantly to 44.5% in 2024. The macro picture improved. Yet conventional long-term financing was still totally absent.
Wait, really? Even with the improved macro picture?
Exactly. To secure liquidity, they needed a $150 million US dollar debt facility from the DFC, the U.S. Development Finance Agency.
So why did that specific facility work when the commercial banks just flat out said no?
It comes down to mechanics. The facility was strictly matched to the long-term tenors of MEX mortgage assets. They didn't just ask for a loan, they structurally aligned their asset class with the DFC's precise duration requirements.
I see. So it is all about matching your asset to their mandate. And looking through these notes, geopolitics and thematic impact are acting as ruthless investment filters.
They really are.
Delphos points to a $125 million US dollar DFC senior debt facility for ONEX shipyards in Greece.
Yeah, that one is fascinating because you have to ask, why is a development bank funding a Greek shipyard? Well, U.S. natural gas supplies nearly 20% of Greek demand.
Oh, wow.
Right. That shipyard is critical infrastructure for repairing and servicing the vessels that transport that LNG. It closed strictly because it locked into the mandate of European energy security.
Which perfectly illustrates the mechanism. Geopolitical risk does not eliminate institutional capital, it merely reshuffles it toward properly structured deals.
Exactly. And if it is not geopolitics, it is thematic impact. Like MAXXA in Chile securing a $7 million US dollar debt facility by bypassing traditional collateral gaps and, perfectly hitting impact investor metrics for financial inclusion.
It really changed the entire approach.
It does. Delphos emphasizes that successful transactions must be engineered around these institutional constraints before submission. You cannot take a standard commercial framework, get rejected, and try to retrofit it into a development finance mandate.
The old plumbing no longer works for you. For your next transaction, you must ask, does the current capital structure preemptively satisfy the rigorous governance, risk pricing, and investment committee readiness requirements of institutional lenders? Or does it rely on conventional frameworks that are no longer viable?
That is the ultimate filter right there, and it leaves you with a final thought to chew on. If capital now strictly follows the mandate rather than the market, is the industry moving toward a world where your compliance and impact strategy is actually more critical to securing liquidity than your traditional financial modeling?
This has been Delphos Insights. Subscribe for the full conversation each week and learn more at delphos.co.